Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Rexford Cattanach, who's the president of Keats Group, and we'll be talking about tax planning with high net worth clients. Rexford, welcome back to the program.
Thank you, Mike. It's good to be back.
Hey, so I know this is a really powerful topic because I think that too many times people get into the mode of just here's my, proverbial shoebox full of receipts. Let me take it to the CPA and fill in the blanks to fill out my taxes. But tax planning takes a whole new approach. That's proactive. So talk a little bit about what tax planning is as compared to typical individuals or business owners, and then also how it contrasts with a high net worth client.
Well, we can start with the high net worth. The late, great Charlie Munger, who is Warren Buffett's partner at Berkshire Hathaway until he passed away late last year, they worked together for 45 years, and Charlie was still working in the business at age 99, if you can imagine that.
Wow.
He wrote in a biography, in terms of business mistakes that I've seen over a long lifetime, I would say that trying to minimize taxes too much is one of the great standard causes of really dumb mistakes. He said that in his book. And then you look under the covers a little bit. Let's recognize that Charlie Munger and Warren Buffett are among the richest people in the world and had a tax rate below 1%.
Wow.
So the conclusion from that is they have world-class tax advisors and they are immensely, charitable. So those are the lessons learned from that quote. The lay of the land, there were a couple of pieces of retirement legislation, well-known, well-publicized. It's the Secure Act and the Secure Act 2.0 that are impactful areas for people with meaningful wealth and meaningful IRAs, to cite one specific example. And they contain a lot of tax landmines. So Congress has turned IRAs into a poor asset for wealth transfer. And many professionals or business families have large retirement accounts where they have an untaxed asset with zero basis or low basis in the business. And to cite the example of regular people who are not necessarily high net worth, my father passed away about a year and a half ago, and he had crossed into his 90s and was not a wealthy man, but my father had some assets, including 2 small remaining IRAs. And now when you're above 90 years old, you don't have large IRAs anymore. You've been forced to distribute those funds for a lot of years. But he had small IRAs remaining. 3 of us children, all close, inherited those IRAs. And so you had 2 IRAs that were broken into, frog in my throat, that were broken into 3 beneficiary IRAs, all with required minimum distributions. And those accounts came by privilege of the broker-dealer with 3 new account setup fees and 3 account closing fees when all 3 of us decided that we weren't going to continue to hold a $1,500 asset with required minimum distributions for the next 20 years. So that's a quick snapshot of tax planning. There were many things that we should have done with him. He was well planned. He was well organized. He knew how to work a spreadsheet. But he had done a number of things on the tax front that were really missed opportunities.
Mm-hmm.
So if I use the IRA example, for higher net worth families that might have a $1 million IRA, you really have an IRA statement in your name for $1 million. but the government owns 40%, 50%, maybe more
Yeah.
of that $1 million IRA. And to get
Because
money
it's
out
never
of
been
that,
taxed.
it's never been taxed.
Yeah.
And to get money out of that traditional retirement plan, let's take a common tax planning strategy, a Roth conversion. Every financial advisor with a billing sheet in their pocket is ready with a Roth conversion. But there's more than just the concept of Roth conversion. There's the mechanics of how you do it well. And there are some misconceptions, I think, that they should not generate higher taxes for you when you do Roth conversions. Higher income clients are not eligible to contribute to a Roth. The accounts have contribution limits of $7,000 or $8,000 a year, depending on your age, and an income limit to make a full contribution. And for a married couple, that's about $230,000. But Congress allowed Roth conversions to continue under the Secure Act. The final rules are out, and that's still the case. Roth conversions are allowed. Now, a Roth conversion is a transfer of funds from a traditional IRA directly to a Roth IRA, and that's taxable at your current marginal tax rate. If you're 59 or older, and really Roth conversions below 59.5 are generally not a good idea, rarely a good idea. You're not going to incur a penalty, but you are going to pay income tax. And so if you take a $1 million IRA example and you convert $100,000 of it in 1 year, the conventional wisdom is to convert, enough dollars to optimize a current tax bracket, an effective tax bracket, but not bump you into a higher tax bracket.
Mm-hmm.
I think this thinking is flawed. I'm not a fan of tax bracket management. I think it's a rather small and uncontrollable strategy. When you convert $100,000, you could bump into a higher marginal tax bracket. And let's just say that if you took that $100,000 and it bumped you into a 32% bracket, you were in a 24. You still have the lower brackets to use up. You're not going to be taxed at 32% on all 100,000. You're going to fill the other brackets up. And so let's just say the math is $50,000 at a 32% higher tax bracket. You're going to pay $4,000 or $5,000 in taxes that year. But you've now taken $100,000 out of a taxable account. And if that $100,000 grew for 20 years at 7%, you're going to wind up with an account with $400,000, all taxable to you or your spouse or your beneficiaries. And it's going to cost you a lot more than the extra tax you paid. Now, one added comment, it really is most wise to do a Roth conversion with when you are able with cash or other sources of cash that are not in the retirement plan. You do not want to withhold some of that converted funds to pay the extra tax. You want to have the ability to pay the tax with outside funds.
And you need a little bit of runway for then the money in the Roth to grow tax-free to make it worth your while. So there's a couple of things there working together, right?
You do. That's correct. Yep. There tax management strategies, not only with retirement accounts, but including retirement accounts, they abound in family businesses as well, using compensation or retirement benefit plans, which today, with the Secure Act, a retirement benefit plan for a company that does not have one, which is the most small businesses, they can be started with up to 100% federal tax credits. You can start a plan and even have some of the contributions to that plan for employees paid by the federal government for a period of time. There are tax penalties to widows, who will file, or widowers who will file as single taxpayers on the death of a spouse. The tax penalties are dramatic when you become a single tax filer. In all kinds of areas that we just don't think about. A homeowner couple, who gets a $500,000 lifetime home sale exclusion receives instead a $250,000 home tax exclusion or capital gains exclusion beginning with the first tax reporting year as a single taxpayer. So in the year of death, you have that tax year to be able to take advantage of a $500,000 capital gain on a primary home. Those are the kind of things that we don't think very often about.
Mm-hmm. So you mentioned tax risk, legislative risk, and we've talked about several of those options. What are some of the final thoughts on how those fit into properly structuring a financial plan?
Yeah, well, an example of the tax risk is, if I go back to the Secure Act, overnight the Secure Act eliminated something called the stretch IRA, which if a large IRA was inherited by children, let's say children beneficiaries, those children who inherited the IRA could spread or stretch the withdrawals or income from that IRA over their lifetime. So think about that. If you have a 30-year-old or even a 40-year-old might have a 30-year life expectancy to take income out of the IRA. The stretch IRA now requires that distributions or that entire fund be depleted within 10 years. So you might have, marry an attorney in a successful law firm in peak earning years, inheriting a large amount from $1 million IRA or a $500,000 IRA, who's in their highest income earning years, and now have to begin depleting that account either every year or at the end of year 9 before 10 years. Those are tax risks. Before the Secure Act actually took effect. That's a legislative risk. So a legislative risk is any risk that Congress could change the rules. A tax risk today is the standard deductions that we enjoy, and the estate tax exemptions that we enjoy that are nearly over $30 million for a 65-year-old couple. They drop by nearly half 16 months from now. Because the Tax Cut and Jobs Act came with its sunset legislation, and those tax planning windows close at the end of December 31st, 2025. But an example of legislative risk is prior to 1994, I think it was, Social Security income was not taxed until it was. Legislation passed in 83, took effect in 1984, and imposed taxes that started at 50% and then went to 85% of Social Security income as taxable income. So we can think of legislative risk as something that takes place every 2-year election cycle, regardless of what party wins.
Yep.
The rules can change and we can't control it. The way to control it is tax planning and exploring one of a myriad of ways of zero tax assets. We spend a lot of time thinking about.
Yep. That's not a fun topic, is it? So from working with clients for so many years, I'm sure you've seen people make good decisions, bad decisions, and been misinformed. What are some of the misconceptions that you find clients have regarding their tax planning that are people that are high net worth clients? Because I feel that there's some things that they let slip through the cracks because they just don't know. What is it? Some of the things you're seeing?
Well, I think some of the conventional wisdom about taxable and tax deferred accounts is an area that is where people draw conclusions that are not always best for them. We think that having a dividend paying set of stock funds in a retirement account defers that interest, defers that income, and therefore it's not taxable. And so interest earning accounts or fixed income earning accounts ought to be in pre-tax retirement accounts. But keep in mind when those dividends or earnings in retirement accounts compound, they're compounding before tax. And so you are triggering not only a future income tax bill, but a capital gains bill from those that stacks on top of your ordinary income. So I think that's a dangerous slope to conclude quickly without some analysis and careful thought, careful planning, where your assets ought to be invested. One way of thinking about this, making the point that I just made, is having zero dividend stocks in a taxable account. If you think about that, a zero dividend stock in a taxable account does not throw off income. There's no short or immediate term tax. They can appreciate. There is no tax as long as they appreciate until you sell them. If you sell them because you needed them, money from those funds for an emergency fund, your worst case is capital gains tax. And if you don't use that money and it transfers through your estate to beneficiaries, it gets a step up in basis, zero tax. There's an example.
Yeah, huge.
Other areas, gifting is a major area of planning with qualified charitable distributions, which allow us to use our RMDs to gift to charity and reduces our taxes at the same time.
I think that the old saying, people just don't know what they don't know. That's a scary proposition, because if you know about something, it gives you the opportunity to implement. But if you don't know, and you mentioned stacking, if you don't know that one could stack on the other and cause a whole lot more tax liability than you needed, it might be smart to kind of know about that. So I think that is really a powerful mindset that people need to keep in mind. What do you do with when you're working with clients that are, multi-generational, and talking with them about the end, like wealth transfer? So like, we talk about exit planning for a business. Well, in one sense, it's exit planning for your family, because when you exit, you need to make sure you're transferring your wealth in the best possible way. What are some tips that you work with your clients on there?
Well, I think the professionals that are doing this are focused on goals and not risks outwardly. And by that, I mean, I think that there are a lot of financial plans that are put together based on fears of market risk, and thoughtful plans, ought to be a deep dive on goals, especially for multi-generational families, for blended families, very big issue that ought to be done with as much care. There are advanced uses of hybrid insurance, trust strategies that are still effective. Some of the old trust strategies are not appropriate for post-Secure Act world, but there are still some sophisticated trust strategies that work very well for asset protection and provide some not only tax advantages, but flexibility for supporting the income of a surviving spouse, with perhaps an irrevocable trust where you can't revoke the trust, but you can guide the income and the distribution of those assets even after death. For these families, we also pay a lot of close attention to not only tax risks, which we've been talking about, but lawsuits and creditor risks and risks from blended families in divorce. The risk of wanting to support your children as beneficiaries, or second marriages, and all of the legal pitfalls or landmines that are involved in being disinherited. And we see those in real life.
It really is like a gift. When you're planning this for your family wealth transfer, it just really is a gift to have a nice, clean plan for them, isn't it?
It is. Yeah.
You finished your thought there you were making?
Well, I popping out of my mind was the issue of healthcare.
Yeah.
Probably the most common major risk that families face. All this debate about should we have long-term care insurance, and I think I could tell my father's story about that too. He had a long-term care insurance policy, and I've had many clients that had them. And there are often better strategies using, asset-based insurance options that are excellent replacements for long-term care insurance.
Yeah. Yeah, just to know those options. And we're talking here about tax planning. Well, the key word there is plan. And if you have a plan in place, and if it's well ahead of when you need it, then you've got time to carefully and cautiously make adjustments or choose the best option. And like you were mentioning previously about the Roth conversion, if you do it too late toward retirement, then you don't have time to recoup the tax hit and the growth in the tax-free environment. So similar things with many of the points that you're making there is make a decision to understand all the options in front of you well ahead of when you need it. And especially if you have a higher net worth, every single little percentage point is amplified. Because if you have a higher net worth, boy, one little deviation or one little change in a positive direction can really make a big difference. So, Rexford, these have been some really powerful points. Wrap us up with your final thoughts and how can people learn more and connect with you?
Well, I would say give us a call or send me an email. Our website, KeatsGroup.com, has our contact information, or I'll gladly provide my email address, which is rcattanach@KeatsGroup.com. Keats Group is KEATS Group.com, and we'd love to give you a call.
Excellent, Rexford. Thank you so much for coming on. It's a real pleasure talking with you again.
All right. Thanks, Mike.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.